The Monetary Policy Committee, MPC, of the Central Bank of the Gambia convened on June 11 and 12, 2025. The committee reviewed recent economic developments and assessed risk to inflation and growth outlook. Following deliberations, the committee decided to maintain the monetary policy rate, MPR, at 17%. The summary below outlines the key discussions that informed this decision. The global economy continued to experience a slow and uneven recovery on the back of heightened trade fragmentation, rising debt vulnerabilities, and climate-related supply disruptions. In its April 2025 World Economic Outlook, the International Monetary Fund, IMF, downgraded its global output projections by 0.5 percentage points to 2.8% for 2025, which is lower than the 3.2% estimated for 2024. Similarly, the OECD and World Bank also projected subdued global growth for 2025. Global headline inflation continued to moderate, but the pace of moderation remained slow. The IMF projected global inflation to average 4.3% in 2025, which is lower than the 5.8% recorded in 2024. This reflects the effects of monetary tightening and subdued global commodity prices. However, core inflation remains persistent in many economies due to strong wage growth and service sector price pressures. Moreover, inflationary risk persists, particularly in emerging market and developing economies, due to currency depreciation, commodity price volatility, and climate-related supply disruptions. Global trade is expected to weaken further, with trade volumes projected by the IMF to grow by only 1.7% in 2025. This reflects rising protectionism and trade barriers, regulatory divergence, and ongoing political bottlenecks. Financial conditions have eased slightly in advanced economies, but remain tight in many low-income countries, constrained by elevated risk and limited access to external financing. Global commodity markets remain volatile, shaped by geopolitical instability, climate-related risk, and uneven demand conditions. In recent months, however, crude oil prices have declined notably, reflecting softer demand and ample supply. Brent crude declined to an average of $64 per barrel in May 2025, which is the lowest level since the COVID-19 pandemic. The FAO Food Price Index declined by 0.8% in May compared to April 2025. The decline in cereals, sugar, and vegetable oils more than offset increases in dairy and meat. Despite this month-on-month dip, the index was 6.0% higher than the level it was a year ago. In contrast, the FAO All-Rice Price Index rose by 1.4% in May 2025. For net food importing economies like the Gambia, these shifts in stable commodity prices continue to be a primary driver of domestic inflation dynamics. On the domestic front, the Gambian economy is expected to maintain its growth momentum in 2025 and over the medium term. Preliminary estimates from the Gambia Bureau of Statistics indicated that real GDP expanded by 5.3% in 2024, higher than the 5.0% revised figure for 2023. Growth was supported by strong performance in the services and industry sectors. Agriculture, on the other hand, contracted by 1.1% in 2024, due mainly to unfavorable weather conditions during the past rainy season. The central bank staff forecast the economy to grow by 6.5% in 2025, underpinned by improved business sentiment, public infrastructure development, tourism, financial services, and telecommunications. Despite the favorable outlook, the domestic economy remains vulnerable to external shock, particularly commodity price volatility, ongoing global trade fragmentation, and climate-related risk. The findings of the central bank's business sentiment survey reveal cautious optimism among respondents, with firms expecting a gradual improvement in economic activity in the next quarter. Inflation expectations remain elevated but have started declining. On the external front, preliminary balance of payments estimate showed an improved current account in the first quarter of 2025, driven by stronger tourism receipts, steady remittances, and lower electricity imports. The deficit narrowed to $13.2 million or 0.6% of GDP in the first quarter of 2025 from $21.1 million or 0.9% of GDP in the fourth quarter of 2024. The deficit in the goods account narrowed from $297.1 million or 13.0% of GDP in the fourth quarter of 2024 to $248.1 million or 10.3% of GDP in the first quarter of 2025. The trade deficit continued to be driven by the importation of fuel, electricity, and food amid a low export base. The domestic foreign currency market continues to function smoothly with robust activity volumes. In the first quarter of 2025, total activity volumes measured by aggregate purchase and sales of foreign currency increased to $670.1 million compared to $600.9 million reported in the same period a year ago. Private remittance inflows, which continue to be a major source of foreign currency supply, amounted to $207.9 million in the first quarter of 2025, higher than $187.2 million reported in the fourth quarter of 2024. The United States continued to be the largest source of diaspora remittances, accounting for 26.3% of total inflows during the quarter. The exchange rate of the dollar continued to be relatively stable, reflecting improved market confidence and supply conditions. From January to March 2025, the dollar depreciated against the United States dollar by 1.7%, the British pound sterling by 0.2%, the CFA franc by 0.5%. However, The domestic currency appreciated against the euro by 1.2% during the review period. The central bank continues to hold comfortable level of international reserves amounting to 508.54 million US dollars as at end of May 2025. This is sufficient to finance over 4.6 months of prospective imports of goods and services. Preliminary estimates indicated an improved fiscal position in the first quarter of 2025, driven by strong revenue performance. The deficit, excluding grants, fell to $2.7 billion, or 1.6% of GDP, from $4.6 billion, or 2.6% of GDP, reported a year ago. Total revenue and grants increased by 14.5% during the period to stand at $8.8 billion, or 5.1% of GDP. Total expenditure and net lending also increased during the quarter by 0.2% to $10.1 billion, or 5.8% of GDP. In March 2025, the stock of domestic debt slightly declined to $45.6 billion, or 23.4% of GDP, compared to $46.4 billion, or 27.0% of GDP, reported in 2024. In terms of composition, the stock of short-term instruments, including Treasury bills, Sukuk al-Salam bills, accounted for 49.2% of the domestic debt stock. Medium and long-term debt instruments represented 33.9% and 17.1% respectively. The weighted average Treasury bill rate rose from 11.3% in 2024 to 14.6% in March 2025. In the interbank dalasi market, the dalasi remained stable in the first quarter of 2025. Trade volumes increased to 13.4 billion, up from 13.1 billion in the fourth quarter of 2024. The weighted average interest rate declined marginally from 5.6% to 5.3%, following movements in 3 months Treasury bill rates. The banking sector continued to be stable and resilient. From December 2024 to March 2025, total assets of commercial banks rose by 7.2% to stand at $107.6 billion in March 2025. Similarly, customer deposits, the main source of funding for banks, increased by 1.5% to $67.5 billion during the same period. The risk-weighted capital adequacy ratio of the industry stood at 28.4%, slightly lower than 28.5% in December 2024. The industry liquidity ratio was 76.1% in March 2025, slightly lower than the 76.5% recorded in December 2024. On asset quality, the industry's non-performing loans improved to 13.5% in March 2025 from 14.3% in December 2024. The latest stress test results confirmed the sector's resilience to both capital and liquidity shocks. On monetary aggregates developments, the annual money supply grew by 11.3% in March 2025, up from 9.4% in 2024. The increase was driven by net foreign assets of the banking system. Reserve money, the bank's operating target, declined by 0.7%, reversing an 8.5% increase a year earlier. Credit to the private sector grew by 15.1% year on year, compared to 19.3% in March 2024. Domestic price pressures are moderating. Headline inflation decelerated to 8.1% in April 2025 from 9.1% in March 2025, marking the lowest level since early 2023. This improvement reflects better domestic food supply, subdued global commodity prices, and the lag effects of monetary tightening. Nevertheless, inflation is still above the central bank's medium-term target of 5%. Food inflation slowed to 8.8%, supported by subdued global food prices. Non-food inflation is slightly to 7.4%, driven by lower international oil prices and reduced transportation costs. However, core inflation measures reversed earlier declines. It accelerated to 6.9% from 5.7% in March, highlighting persistent underlying price pressures in housing, utilities, and services. The outlook for inflation remains cautiously optimistic, with potential for further moderation if global commodity markets remain stable. However, risks remain tilted to the upside due to the ongoing political tensions, among others. Based on this, the committee observed the following. The global economic outlook remains highly uncertain, posing significant challenges to policy implementation. The unprecedented rise in protectionist policies is stifling global trade and investment, as well as increasing cost of goods and services globally. For the Gambia, these global headwinds underscore the importance of maintaining prudent monetary policy and reinforcing financial stability frameworks to bolster economic resilience. Many central banks have entered a cautious phase of monetary policy easing amid falling inflation and signs of slowing global demand. However, the pace of falling policy normalization remains asymmetric and contingent on inflation expectations and domestic vulnerabilities. In sub-Saharan Africa, the monetary policy space remains constrained largely by inflation, volatility, and external imbalances. The Gambian economy continues to register strong growth with a positive medium-term outlook. However, elevated global uncertainties mentioned earlier underscored the need to sustain reforms, reinforce fiscal prudence, and build policy buffers to enhance resilience and safeguard macroeconomic stability. Inflation is easing but remains above the central bank's implicit medium-term target. While the outlook remains favorable, with inflation expectations expected to stabilize around the medium-term target this year, significant upside risk persists. This calls for a cautious and well-calibrated approach to monetary policy. Now I announce the policy decision. In view of the above, the committee concludes that monetary policy should stay the course and has taken the following decisions. 1. Monetary policy rate MPR will be maintained at 17%. The required reserve ratio of commercial banks will be maintained at 13%. The interest rate on standing deposit facility will be maintained at 4%. The interest rate on the standing lending facility will remain at 18%, that is MPR plus 1.0 percentage points. The committee will continue to monitor developments in both the domestic and global economy in deciding its next policy steps. And for information purpose, the date of the next MPC meeting is scheduled for Wednesday, August 27, 2025. The meeting will be followed by the policy decision announcement on Thursday, August 28, 2025. Thank you very much for your kind attention.